Welcome to the Prophecy Club. Our topics today are two. Number one is the dollar just got shot in the heart, and we just made a new enemy in Venezuela. Now, before I get started, let me remind you that through Thanksgiving, if you'll go to empshield.com, you can order yourself one of these to go on your car, also one to go on your house. And that way, if you get some kind of an EMP, like a suitcase nuke going off in the area or something, hopefully your car starts, your computer still work. Normally, if you use the promo code PROPHECY, you get a $25 discount, a $50 discount on each item. But now through Thanksgiving, you'll get an extra 25% off. So if you've been thinking about getting one of these, empshield.com before the sale is over. Second thing I want to say, if you're thinking about getting crypto, prophecyclubcrypto.com is the place I'll send you to. Now, I put this big go button up here because I know something I can't talk about. There's nothing I can say. I mean, it would get me in trouble to say it, so I just can't say it. But I got some information Friday. Can't say what it was, can't say how I got it, but all I can say is something really big just happened Friday. That's all I dare say. Now, I say that to give you a little bit of a hint. The next thing is related to it, okay? It's really, really important. And no one else can talk about it, and I can't talk about it either. All I can say is the go button has been pushed. All right, so there you go. This relates to it. Now, frankly, I find it difficult to read every word of anybody's anything. But in this case, I might have to read just pretty much every word of what was put on HalTurnerRadioShow.com website because it is so important. Headline: the experts are telling me 2026, everything comes apart. Nothing can stop it. Did you catch that? Okay. I hope you got the hint. There's a $38 trillion time bomb ticking in the heart of American financial system, and in 2026, it's going to detonate. Not with the slow burn of a typical recession, but with the devastating speed of a controlled demolition. Every domino is already in position. Every fuse has been lit, and when the first one falls, the cascade will be unstoppable. Right now, I hope you're getting the hint. Right now, as you're reading this, over $500 billion in corporate debt is racing toward a refinancing deadline. Companies that borrowed money at 3% interest rates during the pandemic boom are about to face 9% interest rates when those loans come due. Banks that seemed rock solid are sitting on portfolios of commercial real estate loans that are worth half what they were 2 years ago. And the very institutions that were supposed to catch the falling pieces, private credit funds, and leverage know Hal does not know about this, okay? Private credit funds and leveraged loan markets are quietly pulling back just when the system needs them most. This isn't another prediction about some distant economic turndown. This is mathematical certainty. The numbers don't lie, the timeline is locked in, and the mechanisms that would trigger this collapse are already in motion. Every expert who saw 2008 coming, every economist who predicted the dot-com crash, every analyst who called the housing bubble, they're all saying the same thing. 2026 is the year everything breaks. But here's what makes this different from every other financial crisis in American history. This time, the government can't save us. Okay, then what happens? We've been talking about the dollar's going to crash, okay? The Fed system ammunition is spent. The Treasury's balance sheet is maxed out. And the very foundation of economic power, the bond market, that has backstopped every crisis since World War II, is about to crack under the weight of unsustainable debt. Let me show you exactly how this domino effect will unfold stage by stage, month by month, institution by institution, because once you see the pattern, once you understand the mechanics, you'll realize we're not approaching a financial crisis, we're already in one. The dominoes have started falling. Most people just haven't seen it yet. The first domino is already wobbling. It's called the refinancing wall, and it's coming at the American credit markets like a freight train. So in 2020, 2021, and 2022, when the interest rates were essentially zero, American companies went on the biggest borrowing binge in corporate history. They issued bonds, they took leveraged loans, they loaded up on debt because money was practically free. The average high-yield bond issued during that period carried a coupon around 5%. Leveraged loans were floating at similar rates. In other words, the big boys with deep pockets were making lots of money by borrowing money. Corporate America gorged itself on cheap credit. But here's the thing about the debt. It doesn't last forever. Those bonds come due. Those loans need to be refinanced. And in 2026, over $500 billion worth of this debt hits maturity all at once. Companies that borrowed at 5% are going to face 8, 9, maybe 10%. That's not just an increase, that's a fundamental shift in the economics of American business. A company that could comfortably service debt at 5% might be bankrupt at 10%. Now you might think, well, these are big companies, they'll figure it out, they'll raise equity, they'll cut costs, they'll find a way. After all, America's just too big to fall, right? The strong ones, the ones with fortress balance sheets and predictable cash flows, they'll survive. But the marginal companies, the ones that were already struggling, the ones that use cheap debt to paper over fundamental problems, they're going to fail. And when they fail, they're going to take their lenders with them. Shadowy banking system. This is where the second domino comes into play. The lenders aren't traditional banks anymore. Over the past decade, the American financial system has undergone a quiet revolution. While everyone focused on regulating banks after 2008, making them safer, forcing them to hold more capital, a shadow banking system emerged. Private credit funds, leveraged loan vehicles, collateralized loan obligations, these institutions stepped in to fill the lending gap left by regulated banks. They now control $250 trillion in assets globally. That's half of all financial assets on the planet. But here's the critical difference between these shadow banks and traditional banks. Traditional banks are regulated. They have deposit insurance. They have access to Federal Reserve emergency lending. They have government backstops. Shadow banks have none of that. When a traditional bank faces a crisis, regulators can step in, inject capital, arrange mergers, prevent contagion. But when a shadow bank falls, it just falls, and it takes its investors with it. Private credit funds have been the marginal buyers of risky corporate debt for the last 5 years. But when banks wouldn't lend, when bond markets got nervous, private credit stepped in. They became the lender of last resort for corporate America. But now, as 2026 approaches, these funds are facing their own crisis. Investors are demanding redemptions. The easy money that flowed into private credit during the boom years is now flowing back out. Fund managers are hoarding cash, avoiding new commitments, preparing for the worst. So just when corporate America needs refinancing the most, just when $500 billion in debt needs to roll over, the very institutions that were supposed to provide that refinancing are stepping back. It's a classic liquidity crunch, too much demand, not enough supply. Oh, it gets worse. And when that happens in credit markets, prices don't just rise, they spike. Companies that might have been able to refinance at 8% suddenly face 10, 15, maybe no financing at all. That's when the third domino falls. Third domino. This sector has been quietly bleeding for 2 years. But most people haven't noticed because the problems have been hidden by accounting tricks, extended pretend strategies. Office buildings across America are sitting 40 to 50% vacant, not because of temporary pandemic effects, but because the permanent structural changes in how Americans work. Remote and hybrid work arrangements have fundamentally reduced demand for office space. Buildings that were financed based upon pre-pandemic occupancy rates and rental income now can't support their debt at current vacancy levels. Mortgages that made sense when buildings are 90% occupied became unsustainable when 50% occupied arrived. And these mortgages, well, they're coming due. Over the next 18 months, hundreds of billions in commercial real estate debts needs to be refinanced. Some of these banks have 30, 40, even 50% of the loan portfolio in commercial real estate. In other words, dum, da-dum, dum, dum. When those loans start defaulting en masse, when office buildings and shopping centers get handed back to the banks at 50 cents on the dollar, these institutions will face catastrophic losses. We've already seen the preview. Silicon Valley Bank collapsed in March 23, the second largest bank failure in American history. Signature Bank failed the same week. First Republic Bank failed in May 23. These weren't subprime lenders or risky investment banks. These were supposedly conservative regional banks that got caught holding assets that just lost value when interest rates rose so rapidly. But that was just the beginning. The real wave of regional bank failures is coming in 2026 when commercial real estate losses finally get recognized. Bond market. The United States government currently owns $38.2 trillion in bonds. That's more debt than the entire global economy produced in a single year or just 2 decades ago. The annual interest payment on that debt is approaching $1.2 trillion, more than defense spending, more than Medicare, more than anything except Social Security. And those interest payments are due every month. As old debt at low rates matures and gets replaced with new debt at higher rates for decades, well, this didn't matter because there was always demand for U.S. government bonds, but foreign central banks bought them. Domestic pension funds bought them. Insurance companies bought them. But U.S. Treasury bonds were considered the safest investment in the world, the risk-free rate. But that assumption is about to be tested like never before. When the credit crisis hits, when private companies start defaulting, when regional banks start failing, when commercial real estate collapses, investors are going to demand higher yields to hold U.S. government debt, not because the U.S. government is going to default, but because the currency that debt is denominated in is going worthless. The dollar is dying. Mathematically, it has to. The Congressional Budget Office has warned that net interest payments on federal debt will total $13.8 trillion over the next decade, rising from $1 trillion annually in 2026 to $1.8 trillion in 2035. But those projections assume interest rates remain relatively stable. If rates spike during the financial crisis, if investors lose confidence in the dollar's purchasing power, those interest payments could double or triple. The government could find itself in a situation where it's borrowing money just to pay interest on existing debt. And that's the definition of a debt spiral. And unlike 2008, when the government had fiscal space to respond, when the Federal Reserve had room to cut rates, when the debt of GDP ratio was manageable, but this time the traditional crisis response tools won't work. The Fed can't cut interest rates to zero because inflation is still a concern. The government can't run massive deficits because it's already running a deficit of 7% of GDP during peacetime. The very institutions that saved the system in 2008 are constrained by their own balance sheet problems. This is why 2026 won't be just another recession. It will be, here it is, a system reset. I hope you're listening. I'll say it again, a system reset. A system reset. A system reset. Okay. What are the prophecies? Hang on. What are the prophecies said is coming? Dollar going to drop 50% to zero. The other one says down a third to zero. They all wind up at zero. Then what happens? Then there's a big earthquake hits because we split Israel. God splits America. But they aren't seeing that. They're only looking at the numbers. Oh, let's go on. The dominoes aren't just falling in sequence. They're reinforcing each other, amplifying the damage, creating feedback loops that will make recovery impossible using traditional methods. Corporate defaults will trigger bank failures. Bank failures will trigger government intervention. Government intervention will trigger currency devaluation. Listen carefully. Currency devaluation will trigger more corporate defaults. The cycle will feed on itself until the entire structure collapses under its own weight. What do the prophecies say? New currency, new constitution, new name, new flag. Let's go on. The signs are already visible. If you know where to look, credit spreads are tightening despite underlying deterioration. Default rates remain low even as the financial stress indicators spike. Consumer debt has reached record levels just as employment growth slows. These are the classic warning signs that precede every major financial crisis. The calm before the storm. The moment when everything looks fine on the surface while the foundation crumbles beneath, the pattern is accelerating faster than anyone anticipated. What took months to unfold in 2008 is now happening in weeks. The velocity of modern financial markets, the algorithmic trading systems, the interconnected global networks, they've compressed the timeline. When confidence breaks, it breaks everywhere simultaneously. Look at what's happening in the leveraged loan market right now. Collateralized loan obligations. The vehicles that package corporate debt, sell it to investors, are now starting to show stress. The CLO market is worth over $90 billion, and it keeps going. These instruments were supposed to be safer than the mortgage-backed securities that blew up in 2008 because they're backed by corporate loans instead of home loans. But the underlying principle is still the same. Take risky assets, package them together, slice them into tranches, sell them as safe investments. The problem is, I can even say it without even reading it. Okay, so if you cut up the risky investment, package them together, slice them up, you still got risky assets packaged together. The problem is that the corporate credit quality has deteriorated dramatically since these CLOs were issued. Companies that were investment grade when they borrowed money are now junk rated. Loans that were underwritten based upon optimistic earnings projections are backed by companies that missed those projections by wide margins. The credit models that justified these investments assumed a benign economic environment that no longer exists. CLO managers starting to panic. They're seeing defaults tick up in their portfolios. They're watching loan prices fall far below par value, and they know what's coming in 26 when the refinancing wall hits. The companies in their portfolios won't be able to roll over the debt. Default rates that have been artificially suppressed by cheap money and extended and pretend strategies are going to spike to levels not seen since the Great Depression. But here's the truly dangerous part. CLOs aren't just held by sophisticated institutional investors who can absorb the losses. Instead, they're held by pension funds, your money. Pension funds, insurance companies, mutual funds, even some bank deposits through structured products. And when these vehicles start losing value, When they have to mark down their holdings, the losses will ripple through the entire financial system. Teachers' pensions, police retirement funds, ordinary Americans who bought their money, thought their money was safe, and now they discover they're all exposed to this leverage bomb that's about to explode. 800, 200 gold, my friends. 800, 200 gold. 800, 200 gold. That's the safe way. Now, if you want to make money, then you go to prophecyclubcrypto.com. Okay, let's keep going. The insurance industry. The insurance industry represents the fifth domino, and it's potentially the most dangerous one because it's the least understood. See, life insurance companies, property casualty insurers, reinsurance giants, well, they've all been reaching for yield in the low interest rate environment, unable to generate adequate returns from traditional government bonds and high grade corporate debt. Well, they've moved deeper and deeper into riskier assets. Commercial real estate, leverage loans, private credit, even some exotic derivatives. American International Group, AIG, was the insurance company that nearly brought down the global financial system in 2008 through its derivatives exposure. But AIG was just one company making bad bets. Today, the entire insurance sector is making similar bad bets, just spread across hundreds of companies. They're all chasing the same yields, investing in the same asset classes, following the same strategies that seemed smart when rates were low, but look catastrophic when rates are high. When commercial real estate starts defaulting, when corporate credit blows up, when CLOs start losing value, insurance companies are going to face massive losses on their investment portfolios. I hope you're listening. But unlike banks, which can raise capital or get bailed out, insurance companies have a different problem. They have liabilities, policies they've written, claims they have to pay, guaranteed returns they promise to policyholders, and if an insurance company's investment portfolio loses just 20% of its value, that's not just a balance sheet problem, it's a solvency crisis. The company might not have enough assets to cover its liabilities. Policyholders will demand their money back, but the assets can't be liquidated quickly without massive losses. It's a classic run on the bank scenario, except it's happening to institutions that most people don't even think of as banks. The systemic risk here is enormous because insurance companies are interconnected with every part of the financial system. They're counterparties to banks through derivatives contracts. They're major holders of corporate bonds and commercial mortgages. They provide credit insurance. I told you this is important. It's long, but it's important. They provide credit insurance to other financial institutions. When insurance companies start failing, they don't fail in isolation. They take their counterparties with them. Who's that? You, me. European insurance giant Credit Suisse shows us exactly how this works when it collapsed in March 23. The bank's problem started in investment banking, but they quickly spread to every division. Counterparties stopped trading with the bank. Clients pulled their money. Credit ratings downgraded. Within weeks, a 166-year-old institution gone, belly up, absorbed by UBS in a fire sale arranged by Swiss regulators. The same dynamic is going to play out across American insurance sectors in 26, except there won't be anyone big enough to absorb the failures. When multiple large insurers are failing simultaneously, when the combined assets exceed the capacity of the remaining healthy institutions, the only option will be government intervention. La-di-da, new system. But the government's capacity to intervene is constrained by its own debt problems. Federal Reserve balance sheet. This brings us to the sixth domino, and it's the one that makes the crisis different from anything we've seen before. The Federal Reserve's balance sheet Since 2008, the Fed has been the buyer of last resort for the American financial system. When mortgage markets seized up, the Fed bought mortgage-backed securities. When corporate credit markets froze, the Fed created emergency lending facilities. When state and local governments faced funding crises, the Fed stepped in with municipal bond purchases. The Fed's balance sheet expanded from $900 billion before 2008 crisis to nearly $9 trillion at its peak during the pandemic. That's a tenfold increase in central banks' assets. The Fed essentially became the shock absorber for the entire American financial system. Every crisis, every market dislocation, every liquidity crunch, the solution was the same. The Fed would create money, buy whatever assets were under stress. But there's a problem. There's a problem with this strategy. It only works if people believe the money that the Fed creates has value. And that belief is starting to crack. Inflation 2021-22 showed Americans what happens when the Fed creates too much money too quickly. Prices spike. The dollar loses purchasing power. Savings get eroded. The social contract that underlies fiat currency, the agreement that paper money has value, starts to break down, fall apart. The Fed tried to regain credibility by raising interest rates aggressively in 22 and 3. They shrank their balance sheet through quantitative tightening. They talked tough about fighting inflation, but they didn't actually solve the underlying problem. They just postponed it. The $9 trillion in assets they created didn't just disappear. It's still sloshing around the financial system, creating distortions, imbalances that make the system more fragile, not less, until the big button gets pushed. Are you reading between the lines? When the 26 crisis hits, the Fed will face an impossible choice. They can create more money to bail out failing institutions, but that will trigger a currency crisis as people lose confidence in the dollar, or they can let the institutions fail, but that will trigger a deflationary collapse as credit contracts and asset prices plummet. Either path leads to economic catastrophe. That's the point. Either path leads to... What did Shane Warren see? He saw a financial storm over all America. What did he see next? Then he saw the dollar falling, worthless as leaves blowing in the wind. Then what did he see? He saw a great earthquake because America split Israel. Finally, he saw miracles return to the church. Isn't this part of what we have been told? Global trade is denominated in dollars. Foreign central banks hold dollars as reserve. International debt is issued in dollars. When the dollar's purchasing power erodes, when confidence in American monetary policy breaks down, the effects ripple through every economy on earth. China, Russia, American adversaries have even been preparing for this moment for years. They've been accumulating gold. The people that know have gold. Creating alternative payment systems, BRICS, reducing the dollar reserves. Remember that Shane Warren was told that silver is going to skyrocket far more than gold. When the crisis hits, they'll be ready to exploit America's weakness. They'll offer their currencies as alternatives to the dollar. They'll provide financing to countries that can no longer access dollar-denominated credit markets. Is this making sense? They'll use America's financial crisis as an opportunity to reshape the global monetary system, reshape the global monetary system, reshape the global monetary system. Isn't that what the prophecy's been saying? The geopolitical implications are staggering. American economic hegemony, built on the foundation of dollar dominance, could end within months of the crisis beginning. Big, bad explosion. The standard of living the Americans have enjoyed for decades, subsidized by the ability to print the world's reserve currency, will evaporate. Country that emerged from World War II as the global economic superpower could now find itself reduced to a regional power dependent on foreign creditors and subject to foreign monetary policy. This isn't speculation, just like Terry Bennett was told. We were warned. It's the logical conclusion of mathematical trends that are already locked in. The debt is real. The refinancing needs are real too. The asset quality deterioration is real. The institutional vulnerabilities, they're real too. The only question is timing, and even that's becoming clearer as we approach the critical dates of 2026. The dominoes are falling. The timeline is set. And whether you see it coming or not, 2026 will be the year the American financial system faces its reckoning. Corporate debt, shadow banking, commercial real estate, government bonds, insurance companies, Federal Reserve policy, they're all connected in a web so complex that when one thread snaps, the entire structure unravels. This isn't a prediction anymore. It's mathematics. The numbers don't lie. The mechanisms are in motion. And the outcome, well, it's inevitable. The only question left is whether you'll be prepared for what comes next. Oh, there's more. Then we get into Venezuela. Okay, so the source confirms that Venezuela has acquired numerous drones, to get to the point, Stan, that can attack our strategic petroleum reserve. In other words, all of our reserve oil that we might need in case of war or a great emergency, and they can take them out. In other words, this article is saying in the middle of when America might be up to its eyeballs in the death of the dollar, all of a sudden Venezuela takes out our oil. Do you see a problem? 800-200 gold. 800-200 gold. That's if you want to get gold or silver. And if you want to get crypto, it's prophecyclubcrypto.com. prophecyclubcrypto.com. If you want to get EMP, EMPShield.com, promo code prophecy. EMPShield.com, promo code prophecy. And yes, we could still use your financial support.
In a world of uncertainty, be prepared with Silver Prepper Bars, your ultimate hedge against political instability and economic turmoil. Introducing the Silver Prepper Bar, crafted from 0.999 pure silver and proudly made in the USA. This tangible, divisible asset can come in handy even in the toughest of times. Portable, perforated, and easily tradable, the Silver Prepper Bar is your lifeline in times of crisis. When facing inflation, currency devaluation, and financial meltdown, Silver Prepper Bars provide peace of mind. Don't wait for disaster to strike. Secure your future today with the exclusive Silver Prepper Bar, the only silver bar on the market divisible into 3 different size pieces for maximum utility, all while fitting in your wallet. The smart choice for savvy investors and preppers alike. With Silver Prepper Bars, you're ready for whatever tomorrow brings. As gold and silver prices continue to surge and top economists predict upcoming shortages, now is the time to secure your precious metals in the form of Prepper Bars, the only bar on the market divisible into 3 sizes for maximum utility. Place your order before supply runs out and prices go up. Don't wait for disaster to strike. Don't leave your future to chance. All payment methods accepted. Order your Silver Prepper Bars now, 0.999 pure silver and proudly made in the USA. Silver Prepper Bars, ready for whatever tomorrow brings. Order now.